Wow, this is absolutely terrible. This is like Vlad shutting off trading at GameStop. This is an over 5 sigma miss from the estimates. This is a really bad labor report. The odds of this happening well under 1% statistically to have this bad of a miss. I was even saying, hey, like, the estimates are for 55,000. The odds of us going negative would be more than 2 standard deviations. Now to go negative 92,000 is absolutely insane. But now what's really absolutely insane is that the Trump administration's BLS with Chavez, whose apparent husband, who is banned from the Labor Department for sexual advances to other workers there, Chavez, the new person that Donald Trump put into charge, who apparently takes employees to strip clubs and drinks on the job, leading a lot of people in the chat to go, hey, I want to work for her. Apparently, she couldn't even rig the numbers to make Donnie T happy here, even though they tried. I kid you not. They told us in the report things like this. They said, the labor force participation rate is at 62%. This is little changed for February. Are you kidding me? It was 60.5. And the markets freak out when it moves 0.1%. It moved 0.5%. It moved massively to the downside. Now, why does that matter? Why does it matter that all of a sudden the labor force participation rate is lower than anything we've seen since January of 2021? Well, what matters is if the participation rate held steady, the unemployment rate would have probably skyrocketed to 5% on this report. I mean, look at the participation rate over time here. They just revised January down substantially as well. We were sitting at 62.4 and 5. We were bobbing around these numbers for a while. We did get to 62.2 in July, but they just revised down January of 2026 and February of 26 obviously came in lower as well. These are very bad numbers. They couldn't even cook the books to hide how bad this is. Now, they blame weather, which is also really interesting because, well, somewhere in here, on one of the pages I saw that they blame weather for this bad February data. But the problem with the February data is that usually we lose about 308,000 jobs in February due to weather. And if I remember correctly, we only lost about 200, there it is. We only lost 228,000 due to weather. So it wasn't really weather because on a seasonal basis, we actually had fewer jobs lost due to weather than we usually do, which that's weird. Construction's supposed to be rebounding because of all the AI CapEx spend. Oh, but wait, construction fell 11,000. And the Bureau of Labor Statistics says the healthcare industry saw its first decline. Remember, education and healthcare have been the very sectors that have been propping up this economy. Even in the ADP report that we were looking at, we're like, there's it is again. You know, you look at ADP employment report. Let me pull it up really quick for yesterday. And we regularly get education and healthcare that drives jobs. So let's take a look right here. Here it is. This is the ADP private report, which indicated a 58,000 job gain for February. Now, keep in mind that this data is based on 26 million private sector employees. It doesn't include the government. But when we look at the government data, it includes 158 million workers, right? This is a lot. These are a lot of people. And so what you have is if you go over to here, employment, healthcare employment declined 28,000 in February, and they say this is primarily due to strike activity. But wait a minute. Strike activity at Kaiser Permanente has been going on since last April. The strike is not news, which is crazy to me. So what they're really doing is they're like trying to textually brand this labor report as good. And This is horrible in my opinion. My bear bull scale has just fallen at least down to 4.7. And I don't even want to look at the market right now. Who knows? Maybe it's rebounding. I want to admit, I get emotional about jobs data because for the last year and a half, I've been on this channel saying we're basically walking on the edge of a cliff and we're just hoping that the foundation beneath us doesn't crumble. That's exactly what I said yesterday. And honestly, I didn't think we would see a crumbling today because the Challenger layoffs report, the ADP report, all the leading indicators were positive for this. Now, in fairness, we came off this crazy, 130,000 jobs report for January that ended up getting revised down. If you take the last 2 months of revisions, we ended up down 69,000 for December and January. December just went to negative jobs, and January, averaged with February, comes in at only 18,000, which is pretty bad. The black unemployment rate, which is historically a leading indicator of recession, shot up from 7.7% from 7.3%. That's not great. This labor force participation rate, being little changed is a complete lie because they're showing us that the number has changed. They're just saying it hasn't changed much because they made most of the revision in hindsight. And that participation rate, again, matters because if the participation rate normalized and was 63%, let's say, the unemployment rate would probably be 5.6%. And this is where a lot of people in the comments that I've noticed have said, Kevin, this is what we've been saying. The labor market sucks. This isn't a good labor market. They're lying to us. Now, in fairness, the labor force break-even rate has come down from about 150,000 to maybe around 50 to as low as 20,000. Some even argue break-even at zero. It's a little hard to tell, and there are many different economist estimates for this, mostly because of immigration, which probably made up about half of that difference. But now you also have some people not showing up to work, plus the early impacts of artificial intelligence, and ICE rates, both of those things combined. One for people not showing up to work, and then, of course, the other potentially inducing lower hiring, maybe even layoffs, which certainly we've seen announced at not just Block in the last week, but Morgan Stanley. These are big layoff numbers. Now, the problem is this is really stagflationary. This is not good. Now, the market probably, in my opinion, and I even said it in my alpha report this morning, Kevin's probably going to be too emotional about this data. The market will probably buy the dip on it. And so far, first 4 minutes here, kind of looks like it's trying to, but I think this data is exceptionally bad. And it hurts me from wanting to buy the dip when we have such bad data, because I know now we are in between a rock and a hard place. Think about this. Kevin Warsh is going to be the next Fed chair. And if we have now negative jobs data, the one thing that was holding us back from a recession, we really need to rely on a Fed chair to help essentially bail out the economy. Okay, this isn't even about just keeping the stock market up. Who cares? This is about keeping the engine of the U.S. economy going. The problem is the Federal Reserve can't cut rates because you have war in Iran that is leading to oil price inflation. It is leading to goods price inflation as the Strait of Hormuz not only shuts down shipping for oil, but also goods and supplies that travel to Europe. This is not good. Now, hopefully this ends and the war is shorter term, but the last time we made a bet that an Israeli invasion would be shorter term, it ended up lasting 2 years. So I don't know that we can make a bet on short-term or transitory inflation from war. That's not good. Then you have tariff inflation, which, yes, now we're getting some tariff refunds, which Donald Trump is fighting tooth and nail. Federal judges have ordered it. Howard Lutnick will get, and his firm will get their, corruption dividend, basically, by all the tariff refunds that they've bought for 20 to 30 cents on the dollar. What a surprise. The very own policy that they created, they essentially shorted their own policy to make money off the backs of Americans. That's corruption. But the point of this is the Federal Reserve is screwed because you're in a place where inflation has started to rise, not fall. We've lost the trend of falling towards 2%. Yes, we are coming upon year-over-year inflationary effects. And year-over-year inflationary effects, they might help. They might. Because year-over-year, we might have this peak that we hit in April, May, June, right after the 90-day pause, in other words. And after you hit that peak, it's entirely possible that the inflation rate starts falling. But the question is, how bad is the labor market going to be at that point? This BLS labor report is, in my opinion, complete fugazi BS. This is not good. Again, they're blaming strikes that have been going on since April for the one leg of our economy that has been gaining, all of a sudden losing jobs. That's the healthcare sector. Healthcare and education, those have been the ones that have really been gaining, right? Let's go look at the households report for a moment. Mind you, the households report is already a lot weaker from December because of the massive revisions that we've seen in the civilian labor force. But here you could see this collapse in the participation rate where we sat last year at 62.5. December 62.4, and then of course we had this revised down participation rate for January, and then this 62 over here for February, which that's why they're calling it little changed. But that is a massive plummet in the participation rate, which again, the reason that matters is if that participation rate were stable and these numbers came in as bad as they did, the unemployment rate would be way higher. So this is actually an environment where you could end up seeing some rigging where if you rig that participation rate down, you can basically turn the dial down of the unemployment rate, which is not great. Okay, so here, what I want you to pay attention to is you can see the civilian labor force right here in December was actually sitting at 171.4 million individuals. So that's 171.4 million. That was revised down by essentially a complete 1 million jobs. That's because of the 2025 revisions that led us to only have an average of 25,000 job gains for the year. Remember that nearly 1 million jobs revision down for January? It was like 900 something thousand. It's now over 1 million down from January. That is a massive decline. Now, because this participation rate moved down, we're actually able to indicate that what do we have here? Let me see. Here's the employed. That's the civilian labor force. So that's cut off. Here's the employed population, which here you can also see that nearly 1 million drop. This is closer to that 900,000 number right here, in case you're wondering right here, because this is the employed number. Top is the civilian labor force. Okay. Here, we could see that the household survey between January and February was also hit. 163.97 minus 162.912. This was hit by 185,000 on the household survey. That's remarkably bad on the household survey. And that's often seen as a tool or a proxy for, hey, what's really being hidden behind the data. Now, the unemployment rate bases off of this number here, but the headline number that we read off, that 92,000, is what's called the payrolls report. The payrolls report is a survey that's conducted by the Bureau of Labor Statistics, picking up the phone and calling employers and sending employers letters and saying, how many people have you hired? It takes about 3 months to get that data back. And so that is why we tend to have 2 months of revisions. So December gets revised in January and in February, right? So you get 2 more months of revisions. That month plus 2 more months of revisions. So you get a first revision and then a final revision. I don't think they end up going to a third revision because usually they collect all the data, all the useful data within 90 days. But I'm pretty sure that includes the first 30 days of the month. But I have to fact check that. but I'm pretty sure it's only 2 revisions. It might be 3. But anyway, so that's one of the reasons we see the revisions. It takes time for the employers to send those letters back. The household survey is conducted by calling individual households. And by conducting a randomized sample, as a statistician would, of sort of a household labor market, you could potentially double count jobs via the payrolls report that you don't in the households report. And that's why people see the households report sometimes as more important, although it can fluctuate a lot more. Negative 185,000, that's not good for that. It's negative 92,000 on the payrolls report. That's also crapola. Now I'm going to take a quick look to see what else, if anything, the suits have here. I've mostly just been reading this report. But again, a negative 92,000 read here is bad. Kevin Hassett says this is due to crazy weather. Though I want to just remind you, because you're going to hear this kind of crap, our seasonal average decline, quote, due to crazy weather, or due to weather, is 308,000 jobs to the downside. We seasonally adjust that because we usually always have bad weather in February. I mean, unless you're in Utah. Utah hasn't been getting a lot of good snow for this ski season. But my point is, we only lost 228,000 jobs due to weather. So we actually, if you subtract those two, 308 divided by, or minus 228, we actually had 80,000 fewer job losses than we normally do to weather. So this was not due to crazy weather. That's Kevin Hassett gaslighting you like the shill that he is. This is complete bullcrap, and somebody just needs to call it out for what it is. They're lying to our faces, and they're trying to rig the report by telling us, oh, don't worry, things have barely changed, bro. This is nonsense. Little changed. And then again, they're blaming strike activity. I don't know if I showed you the page yet, but here's where they blame strike activity. But strike activity has been going on since last April. Come on, the Kaiser Permanente strikes. This is ridiculous. Okay, let's see what else we have here. Payroll's 3-month moving average is down to 5.7 thousand in February. That's even worse. I gotta write that down. So a couple extra things to write down. That's gonna be the negative 180K household survey, and we have the fell to 5.7K 3-month moving average of jobs. This is very bad. Mind you also that Jerome Powell typically says that whatever the labor report is, take like 40 or 50,000 off of it. So if we're a negative 92,000, take another 40 or 50,000 off of that, you've got a really bad recessionary labor report. This is, I mean, like, I get emotional about labor, but this is, like, I'm trying to temper how bad this is because it's so bad. Let's see here. Measures of perceived U.S. credit risk were hit their worst levels in months Friday, adding to moves after employers unexpectedly cut jobs in February and the unemployment rate rose. The spread on the market CDX North American Investment Grade Index, which rises as credit risk climbs, widened by as much as 2.6 basis points, the highest intraday level since May of 2023. That's not great. Let's see here. U.S. consumer confidence is super low. Conference Board February reading was 91.2. That compares with 104.9 on average over 23 to 24. Let's see here. Let's see. Okay, now let me look at what. See, this is crazy. This is absolutely nuts, by the way. Look at this. Ordinarily, in a normal market, you would actually have treasury yields collapsing right now. People would be fleeing to safety in treasuries right now, but it's not happening because the Fed can't cut rates. Because look at oil. Oil's up 9.7% today on the Western blend, up 6.69% on the international blend. Natural gas also moving up about 3.6. Keep in mind the United States produces the vast majority of its own natural gas, so we tend to be a little bit more insulated with natural gas increases due to geopolitical issues, whereas European countries do not have that luxury. European countries tend to see substantially greater increases in nat gas prices, usually to the tune of 50 to about 100%. So that's half to double more, right? So the bond market is not reacting the way you would anticipate at all here. Now, what's bizarre is, and this is just weird, the 10-2 yield curve is still at 55, which is much lower than where we have been, because the bond market isn't reacting the way you would expect after this. You would expect a collapse on, honestly, the 2 and the 10-year today. I don't think you're seeing that at all. Let me see the 2-year treasury. You would expect both to collapse, and honestly, the 2 should widen more. It is. See, the 2's going down a little bit. You would expect this to collapse, mind you. If it weren't for the war, this would probably be down, in the 340s would be my guess. Well, let's see, where were we? Oh, we were at, we closed here at 337 at one point, below the 340s. We might be as low as, the 320s on the 2. If it weren't for the war inflation fears, especially since Donald Trump is, demanding essentially unconditional surrender, right? So overall, again, I personally, I'm very bearish on this data. I don't like it. I know that 1 month doesn't make a trend, but the trend has been collapsing. The 3-month moving average is at 5.7 thousand, and the 2-month moving average is at about 18,000. Those are already really bad trends. Well, let's go back to the BLS report just for a moment, and they should really just drop the L and just at this point, just call it what it is, which is a BS report. I want you to see the black unemployment. Does it show it here? Yes, here. Black unemployment rose from 7.3 to 7.7. You have to compare to the prior report to see this one. Unfortunately, also, that is, as we mentioned, a leading indicator of recession, which is not great. So as I mentioned earlier in the video, we are, my bear bull scale plummets on this. I'm probably at, I said 4.7. I'm going to go 4.5 on this. So this is pretty bad. We're going to write this down so you could see it, and I'll show it to you graphically as well. Negative 92K jobs report, major miss, participation rate collapses, which would have skyrocketed the unemployment rate had it held. And then on top of that, we have negative 180K on the households, right? This is a very bad report, despite decent and slight rebounds in Challenger, ISM, S&P, and ADP reads over the last 2 to 3 months. Not all of them have been reporting this rebound for 3 months. Many have only seen it for 2 months. So I don't know what happened here. If it's just like, who knows? Maybe this is just coming off the back of like a crazy January or whatever. But this is wild. Now look at my graphic here. This just shows you, obviously, this is going to create an inflection point in the bear bull scale. This is quite enough. If we get a second report like this, I just want to be clear. I'm gonna make this commitment right now. Okay, if we have a second report, if March is equally this bad, we're probably down at 3.9 or in the threes. Like it's just bad. I really want to be optimistic, and I think again, I feel like I'm Mr. Employment guy. Maybe that makes me emotional about this, and so I'm trying to be self-aware of that. Like I'm not gonna trade off of this. I know that days when I'm like a frazzled, I can't trade well because I try to trade with logic and reason, and there's so much here that just has my head spinning because I feel like this is the first labor report I've seen where we're just truly being gaslit. You can't tell me that this was due to weather when we had 80,000 fewer job cuts due to weather than we do on a historical seasonal basis. That is a blatant lie. This covering up of a little changed labor force participation rate to mask that the unemployment rate is somehow staying low is, in my opinion, a complete lie. I think it's wrong. And I believe that the Federal Reserve is screwed. I don't think that they can cut rates this year, but they're going to have to. Now let's go see a CME group. So CME Fed Watch Group, or Fed Watch tool. If we look at rate projections here, we are looking at a 4.5% chance of a rate cut here on March 18th. If I jump over to December, we are still pricing in at least, it shifted a little bit, hence why we've seen a little bit of red in markets. We're now pricing in a 17% chance that we remain the same all year. Hold on, let me make sure the range is right. Yeah, that's 17% chance that we get no rate cuts all year. We're still pricing in an over 80% chance of one rate cut. And then we're pricing in about a 45% chance of two rate cuts. So we're starting to see that dynamic shift where we're starting to unprice that second rate cut that the market has priced in. I personally think that with the inflationary data that we've been getting, which the last CPI report didn't leave anything to be desired either, it's indicating that our progress on inflation has stalled, which suggests we're at a stagflationary point. The Federal Reserve likely can't do anything for us. I doubt anything's going to happen under Jerome Powell, and so it likely means that our first rate cut might not come until later this year. But 25 basis points of cuts, if this is our true labor market, isn't going to cut it. They're going to have to cut rates rapidly to zero, but they can't until the inflation demon is solved. And one way you could do that, frankly, is in a recession. So one of the upsides of a recession, if there is any, is that prices tend to fall and you tend to get deflation. Now, generally, the market bottoms when the Federal Reserve turns on the money printer. But Kevin Warsh might delay turning on the money printer because he's the kind of guy who doesn't want to debase the U.S. currency and print as much money as is typically printed during recessionary eras, such as under Ben Bernanke or under Janet Yellen or under Jerome Powell during COVID. This suggests that the Federal Reserve probably won't be here to rescue us if this bad data continues, which just means that Kevin Warsh is likely to make any kind of correction more painful. Now, free market, laissez-faire students will say, good, let it collapse, let it fall, and let all the froth truly get blown out. The problem with that is you'll end up seeing private credit end up rolling over into major banking stress, and the Federal Reserve is going to be forced to act sooner rather than later if this sort of labor continues, these labor reports. Now, again, hopefully not. Hopefully we could just, the market's honestly, by holding at 600, it's taking this in much better stride than I would have anticipated, just because the numbers are so bad. I do think that people see this as a buy the dip opportunity. I actually would lower my buy the dipping. So I've already been very conservative with my buy the dipping. I sold a lot of NVIDIA, probably for almost $3 million of NVIDIA, probably for an average of around $190, something like that. And because I sold I sold between 180 and 205, so it probably averaged to like 190, something like that. And, I've bought back and I've sent buy alerts to those of you in the Alpha group. But I've only bought back maybe $600,000 or $700,000. And, I have more capital to buy the dip with, but I'm not because, well, I was waiting for this jobs data. That was one of the things I was saying was like, hey, really low chance we're going to go negative on this report here, less than 2% chance statistically. And let's see what it is, though, and then, that'll unlock me for buying the dip. This doesn't unlock me for buying the dip. I actually think it's almost foolish to buy the dip on a jobs report like this. Now, the broader market's not going to think like I do, and that's okay. I think I frequently come early with my concerns. Unfortunately, there's no mincing words. This is a horrible labor report. Negative 92 versus the anticipation that we're going to be at 55K. It basically indicates that nobody saw this coming. And when nobody sees it coming, it then makes you scratch your head that, well, this was supposed to be the rigged data. The Donald Trump administration, if this is the good data and it's this bad, then what's really happening? Now, obviously that, is a little biased against the administration, mostly because I don't trust the people being appointed as far as you could throw them. I don't trust Lutnick. I don't trust Hassett. I don't trust Warsh. I don't trust Caesar at the Labor Department. I think they're all shills. I think they're all knee benders and borderline fraudulently corrupt politicians. So, I'm not mincing words, but for that cohort, for that team to end up with a group project that indicated that non-farm payroll edged down by 92,000, they're lying to our face. I didn't even notice they used the word edged. Hey guys, it just fell down a little bit. Are you kidding me? We went from like 128,000 job gains last month to negative 92, and you're going to tell me it edged down? I just noticed, I'm telling you, as you read this report, they consistently use words and language to imply that this is not a big deal. And the more you look at the data, the more you look at it and go, what the hell? January was actually revised down to 126. I think I said 128 earlier. It was 126. This is bad. That's it. That's all I got. I'm bearish. I'm not happy. I'm very pissed because honestly, it's probably even worse than they're telling us right now. And that sucks.
Kevin is very talented, but I don't know if it's going to be him, but he's a very talented guy.